This track
Hello. What's going on, everybody? Welcome to a Capital Hungry Monday Market Update webinar. How is everybody doing this evening, morning, night, depending where you are in the world? Can you guys hear me loud and clear? And you should also see a blank gold screen. Daily time chart blank right now, and you should be able to hear me pretty loud and clear. So, through the next 30 to 40 minutes, I will be going through some analysis from the daily time frames to the intraday time frames, including fundamental point of view, as well as trade ideas on gold, GBPJPY, GBPUSD, EURUSD, USDCAD, and US30. Let's jump right into it, shall we? So, if you've been following the previous market update webinars or any of the analysis I've shared on my YouTube channel here, obviously for free, you would understand that over the last period of weeks, we have been playing some primary corrective phases and pullbacks against main trend. The reason for this across the board is a lot of the fundamentals of the aggressive rate hike cycle by the Federal Reserve, which was initially signaled during the end of April, around April 23rd IMF meeting. A lot of that information has been priced in. So we've been seeing a dollar index pullback from the highs. We've been seeing an aggressive bounce on the US stock market from the lows. We've been seeing an aggressive bounce on pairs like GBPUSD and EURUSD from the lows, as well as on gold from intraday bearish market structure. So we're still looking to continue that sentiment in the short term. We've also had ECB, the Euro Central Bank, give discussions in the prior weeks of coming out of negative rate hike territory. This, of course, brought some more strength to the euro individually. One thing we have to note out for is the markets have been very illiquid. Even though we've had that aggressive cat bounce on equities and pullback on the dollar from the highs, as well as the pullback on gold from intraday lows, we have to understand that a lot of these various fundamental catalysts have been priced into the market. So we're seeing the market volume a bit lower and slower in terms of volatility as well, as we are nearing the end of the month and of course have a lot of economic data in focus towards later this week, as we have a bunch of PMI figures in the second half of the week once the new month of June starts, as well as US labor market data, NFP and unemployment data towards the end of the week on Friday. Okay, so some things to look out for. One, we're still playing the short-term dollar pullback from the highs and short-term dollar bears, but keeping in mind we're anticipating the higher time frame buyers to be coming back into play. Two, we're still playing the short-term bounce on equities, but understanding this is a bear market rally, and I'll be showing you guys that in more detail when we look at US30. Three, we have to be adaptive to the current market conditions of lower volume and volatility, as we're coming off of a North American holiday for the US with the Memorial Day. We have some UK and Euro holidays scattered throughout the week in terms of bank holidays. The same time, we're coming off and closing the business month and starting a new business month period, which we can obviously see some skews in volume and volatility. Okay, so some things to stay adaptive with there. As I discussed, I am expecting for the first half of the week up until the start of the new monthly period, we will have slower volume and lower volatility. I'm expecting this to pick up into towards the end of the week towards NFP and into the fresh week of the new business month in June, especially if we can get some new fundamental catalysts to the table to bring an information edge and give us some more volume and order flow with our overall market movement we observe on the main trading instruments that we trade. But keep in mind, coming off the Memorial Day holiday, UK bank holiday in the middle of the week, starting a new monthly period, a lot of the market fundamentals priced in. Don't expect huge volume and volatility. If we get large increases in volume and volatility and new fundamental catalysts at play, that's a bonus for us alongside proper risk management and trade planning. In terms of market sentiment, in the short term, we're still playing US dollar bears. We can see the Japanese yen is starting to turn potentially bearish again, respecting its higher time frame structure. And in the short term, we're still playing an equity market squeeze, US30 stock market squeeze. This current market sentiment reading is the short-term reading for dollar and stock market. Japanese yen individually on the higher time frame is already very well bearish. We're just looking for the sellers to come back into play, driving down to the higher time frame lows. But the US stock market is in a bearish market with aggressive rate hikes coming and very weak US economic data. We just have to understand, based on market psychology, that every time we have a bear market in the US stock market, there is very aggressive bounces from the dips as stock market buyers try to save face and grab the dip, and also set up better price points to liquidate positions out of the market, which I'll be showing you guys very carefully coming up. And on the dollar, the higher time frame dollar is fundamentally and technically bullish. We've just been playing short pullback structure as a lot of the aggressive rate hike cycle rumors by the Feds and rate hikes we have seen so far have already been priced in, with the market adjusted to it accordingly. So when we can come here and look at our market sentiment indicators, coming and doing some quick analysis on the dollar, of course, higher time frame ever since the new 2021 period where we started to get the taper talks by the Feds, the taper process starting, interest rate hike rumors and interest rate hikes. These are all bullish fundamental factors that brings demand back into the US dollar. But it's very normal to understand in relation to the upside moves when buyers print higher highs and push price up to a sell side liquidity zone to have relief and exit out of the market, that we have these very normal pullback phases that are usually in relation to the upside move and bounce for the most part, right? So this very aggressive upside move here on the dollar, which is abnormal in relation to its normal order flow behavior, this was primarily due to a IMF meeting during the April period where we got a lot more rumors from global central banks of interest rate hikes to come. The rumors of aggressive interest rate hikes to come led to this extended squeeze on the dollar as the markets begin to price in and adjust to that information. This day being the actual FOMC and Fed interest rate that followed, that led into these higher highs. So what I am trying to observe based on price points of interest and what I have been observing is how far can this dollar pullback extend? I've been taking it level by level. This first price sensitivity area I was watching as a make or break was the last Fed interest rate day, where we had a price grab to the downside, buy side orders generated in the market, a more hawkish tone from the Feds, and continuation to the upside. You can see we are trading well below there, right? Obviously, as we talked about in our last market update, we've been wanting to play this short-term dollar weakness, right? So now the next price point I'm looking at of interest is the previous highs around 100.8. I can still expect dollar to range down to this price point of interest. This is the next price point of interest where I'm going to be looking for any type of support being created, any type of correlation factor as well, which I'll explain right now. If we can identify dollar coming to this previous high price point area, failing to break, the same time volatility index picks up strength and we start to see stock market buyers jumping out of the market and turning bearish, we can anticipate higher time frame buyers jumping back into the scene to be driving price up in this overall market structure into the previous highs. Otherwise, I'm expecting deeper pullbacks to 99 before dollar would be continuing bullish again. This pullback on the dollar as the world reserve currency and as the fundamentals of the aggressive Fed rate hike cycle have been priced in, this lower demand in the dollar, short-term downside, is the reason we've had such a aggressive bounce on the stock market from lows and an aggressive bounce on gold from the intraday lows. But as we're playing those pullback phases, for example, we've been playing this pullback phase on the dollar against higher time frame trend, right? When you're coming here and looking at gold, ever since this period from the all-time highs, we've been playing this pullback phase from the lows against this higher time frame bearish trend over the last 2-month period. When you're looking at GBPUSD and EURUSD, you're going to see a very similar pattern of being the inverse of the dollar, where we have been playing a pullback from the lows against the higher time frame bearish trend. Now, as we're playing this pullback structure, we don't want to lose sight of the higher time frame analysis and macro bias in play. So keep that in mind. Same thing when we're looking at US equities. This is what I wanted to explain about US equities. For those of you who don't know, the US stock market has been in a bearish market, a bear market, ever since the start of 2022. When we failed to break consecutive new higher highs, had of course Russia and Ukraine tensions coming into play, on top of the Fed signaling at more rate hikes to come, we have been in overall bearish market structure, in a bearish market cycle as well, because of the fundamental reason of aggressive rate hikes to come. You can see, based on market psychology of the 1%ers, the corporations, the institutions, favoring more upside in the stock market, every time we have these aggressive lows and dips created, we have a very large extended upside rally, which still doesn't break the overall bearish market structure and ends up overall being very short-lived, as it just drives price up to better sell side liquidity zones for buyers to liquidate positions from better price points. But during this yearly phase so far, overall the equity markets have been decreasing in value in a bearish market cycle. Does that make sense to everybody? So unless we see the US stock market index trading above 34K and the dollar turning bearish on the higher time frames, we can't let this fade us out of our higher time frame bias, understanding the market structure and fundamentals in play, and understanding that bear market rallies are very, very normal and majority of the time short-lived. What I also want you to understand based on the price action of US30 is you can see these huge bullish engulfing candles on the weekly really end up just being a retail buyer trap, where the next couple of weeks that follow end up showing a lot more exhaustion and overall seeing more sell side orders enter the market and buyers liquidating positions, continuing the overall bearish market cycle. So remember, we've just been playing short-term bears on the dollar. We've just been playing short-term buys on the stock market. We've just been playing short-term buys on gold, GU, and EURUSD. Now that you understand that, I can still see these short-term buys extend a little bit more. Meaning, I can still see dollar possibly come down to 100, 100.8 before continuing bullish. I can still see US30 coming up to 34K flat before turning bearish again. I can still see gold here possibly coming up to 1865, 1870 before turning bearish again. I can possibly see GBPUSD having another edge up to around 2728 before turning bearish. I can see EURUSD coming to better retest these lows at 1.08 before turning further bearish. Does that make sense for everybody so far? Is everybody following along so far? The fundamental sentiment that led to that dollar strength, gold weakness, EURUSD weakness, and stock market weakness being the aggressive rate hike cycle by the Feds, the rate hike cycle being priced in, which has led to this pullback on EURUSD, has led to this pullback on gold, has led to this pullback on GBPUSD, dollar pullback from the highs, and US30 pullback from these dip lows. We're still playing these pullbacks a little bit more on the short term, but starting to anticipate the macro bias coming back into play. The macro bias being equity market shorts if we don't trade above 34K. Dollar buys if we hold 100 to 100.5 area here. Gold sells if we don't trade above 1870s. GBPUSD sales potentially coming at 1.27 area here. And EURUSD sales potentially coming at 1.08 here. Okay? The only thing that's been the same bias that we're still looking to play is GJ buys on the higher time frame. GJ has been bullish on the higher time frame due to the individual weakness in Japanese yen fundamentally, with the Bank of Japan keeping interest rates in the negative, keeping an unlimited bond buying program going, and less global demand in the yen as a safe haven. GBP individually against the yen a lot more bullish because the Bank of England is of course a lot more hawkish. And we can see that obviously in terms of GJ structure, very, very bullish. Potential for us to revisit these high points as targets. Okay, now some things we have to keep in mind. One, end of the month period and new month setting up, which can easily see that we observe as retail traders monthly wick setup, which is really just the institutional market maker, smart money, whatever you like to call it, order flow setting up for the business month. Doesn't always happen, but is very frequent to see what they call, you can Google, end of month rebalance of flows. Okay. Two, something else we have to look out for is a couple of the holidays and stuff we have. So now our economic data. Yes, we still have some economic data to focus on overnight and of course for tomorrow, but a lot of the economic data is in the second half of the week after the new monthly period starts, including like PMI figures, GDP from various countries, labor market data, non-manufacturing PMI, NFP and labor market data from the US at the end of the week. Okay? And this week is also pretty scattered with some holidays, like from China, full day closure, bank holidays on the 3rd, full day closure for UK. We're just coming off the US Memorial Day holiday. So remember, even though we might see these trade ideas in analysis, the current conditions of this week might not allow for some of these trade ideas to play out until we have more healthy volume and volatility. So keep in mind some holidays this week from some major players, start of the new monthly period, and a lot of the more important economic data is in the second half of the week when the new month starts. Does that make sense to everybody? So now, let's look at what economic events we have on the docket in terms of Asian session, London session, and New York tomorrow, which we do still have a lot to focus on, and what political events we have to focus on. So, through our Asian session, impacting Japanese yen, jobs data, unemployment rate, and jobs applicant ratio at 7:30 p.m., 7:50 p.m. industrial preliminary data and retail sales yearly. This is still going to keep Japanese yen relatively softer in my opinion. I can see the unemployment rate being relatively normal. They're expecting a drop in their industrial sector, but expecting a rebound in retail sales. This is more than likely going to have a neutral, very minimal impact on yen movement, or just be setting up potential sells to come on yen individually when you look at the JXY, Japanese yen index overall structure. Okay? Then, Australian economic data. I don't really trade any Australian pairs, but if you guys are trading any of your AUD pairs, through the Asian session, we have private sector credit, housing credit, net exports, business inventories, building approvals, and more. So a mix of various economic data there for any of our AUD traders to keep an eye out on. I personally don't trade any Australian dollar pairs. I do like to keep an eye out on the actual data releases, just in case it has an impact on market sentiment through the Asian session. Okay? 1 a.m. Eastern, housing start numbers for Japan won't have much impact on the markets at all. Then, for our London session overnight, starting at pre-London hours, 2:45 a.m. Eastern, we have some data for France, consumer spending figures, GDP quarterly, CPI preliminarily yearly, and producer prices. It's already expected inflation is increasing and well high. A lot of the inflation data is well priced in. GDP, they're expecting the same as previous, and they're expecting a rebound in consumer spending. I can still see this overall Euro data still give us a continued short-term upside squeeze on Euro USD before we start reaching better sell price points of interest. Okay? Where was I? Unemployment rate for Germany at 3:55 a.m. Eastern, 4:30 a.m. Eastern. Bank of England Consumer Credit Report, mortgage lending and mortgage approvals. The Consumer Credit Report might have a minor impact, more just going to be like a lower time frame type of volatility impact. Nothing too long standing is what I'm trying to say. And the mortgage lending, mortgage approvals won't have too much impact at all. 5 a.m. Eastern, inflation data for Euro. Already well expected in terms of global inflation being high. It's been known for years as we've had the central banks keep interest rates so low and the money printers and stimulus going so actively. Then, during our North American trading session, the New York trading session, 8:30 a.m. Eastern, for any of our Canadian dollar traders, or if you trade USDCAD, of course, GDP quarterly and GDP monthly. Expecting drops on both. So expecting short-term Canadian dollar weakness. Keep that in mind. 9 a.m. Eastern, Case-Shiller data won't have too much impact at all. This is a bit more important from 9:45 a.m. Eastern and 10 a.m. Eastern for the US dollar, Chicago PMI, and Consumer Confidence Report. Both of these reports are expected to be poor. I'm also expecting them to be poor. This poor economic data from the US can keep dollar a bit more bearish, like in the short term, and can keep gold a bit more bullish in the short term as well, going back up to that 65, 70s handle before we start seeing any sellers jumping back into play. Okay? Keep an eye out in terms of some scattered central bankers throughout the day tomorrow, mainly looking at Bank of Spain, ECB overnight. Not too much going on from a political central banker perspective. Now, when we're looking at gold here, you can see ever since this date, this being the last all-time highs where we failed to break, buyers liquidated positions, Russia tensions priced in. We had a bit of a pullback to this price point of interest where at that April IMF meeting, which was around April 20th really, we started to get way more hawkish remarks from major global central banks. Bank of Canada, Bank of England, Euro Central Bank. Sorry, my Epic Pen froze. And Federal Reserve. From this point, we've had sellers in play and printing significant lower lows with only short-lived pullback phases. It's very normal for gold to have aggressive pullback phases. Gold's pullback phase could come to the 1880s before I see a continued sell-off, right? So in the short term, as long as we're still trading above the 1850s handle on the intraday time frames, I can still see with the expectations of poor US data tomorrow that we can still at least squeeze up to revisit these previous intraday highs roughly at the 1870s and 1880s before seeing any potential sell-off. I would only be jumping back into higher time frame sells if we, one, come into the 1880s price sensitivity area here, fail to break, show some exhaustion on the intraday time frames, or two, we're trading well below the 1840s. So with that being said, you can also see on the intraday time frames here, we've been respecting this corrective bullish market structure with the potential to revisit these highs up into the 1870s, especially if we continue to respect this demand zone as stated around the 1850s there, 1845 to 1850, right? So the only thing we have to keep an eye out for is the lower volume and volatility. Obviously, to start out the week so far with the US bank holiday, we've just been more in this intraday range. But in the short term, I'm still expecting some potential upside before setting up higher time frame sells. Otherwise, I'd only be taking sells below the 1840s on gold. Now, when we're bringing that together with some of our key levels and price points of interest, these are the trade ideas I see. If we get pullbacks to 1845, I would still be looking for a rejection, buys above 52, buys above 55. If we break above 65 area, also looking for continued short-term buys, keeping in mind how we react at the previous intraday high. So green boxes I'll mark out as the buy zones after the new daily candle price setup and pullback. Red boxes are the sell zones. Okay, so I would let the pullback complete, fail to break 45, be scaling back above. If you really want, if we fail to break 45, that same demand zone, higher risk, higher reward buy in this area. I would be letting the pullback complete, failing to break that demand zone, then coming back up 55 and 52 for buys, with safer buys above 65 previous intraday highs. This is going to make a lot more sense if dollar continues bearish, we have weaker economic data tomorrow, and we still have this same sentiment in play of stock market buyers trying to squeeze out what they can. If our buy analysis plays out, meaning we have the pullback, 52 buys, 55 buys, 65 buys, I would start potentially looking for sells around 1876 to 1880 area. Okay? Otherwise, this right here is my main bias. I would only be looking for sells otherwise if we're trading below 1840. Now, this 1840 sell is if my main bias is wrong, meaning let's just say gold pushes up first, fails to break 65 previous highs, showing us a lot more exhaustion by buyers. We start to drive down and break below 45. My analysis and trade idea becomes invalidated. This doesn't mean that I just sit on the sidelines or keep trying to buy. This means I adapt to my secondary bias, the adaptation bias, which is safe sells below 1840s. Does that make sense to everybody? Otherwise, this is my main bias and main expectations based on market structure, market correlations, and what I'm explaining to everybody, as well as price action. If my bias is incorrect, because at the end of the day, we're just manual retail traders, we're humans who can make mistakes, I would adapt to sells with the adaptive bias below 1840. And also if we have these sells play out, for example, if we go up to 76, start to drop, I'd be scaling in sells on the way back down as well. If we come up to a better sell point and have our higher time frame structure come back into play. Okay, everybody? GBPUSD. When I'm looking at GBPUSD on the intraday time frames, as long as we're still respecting this pullback corrective structure here, we still have short-term dollar weakness and holding above 1.26. I can see us coming up to 1.275 before seeing the potential sells on the higher time frame. Otherwise, I'd only be selling below 1.255. Remember, on pairs like gold, GBPUSD, EURUSD, US stock market, what we have been playing pretty much since May 16th, you can see May 16th here, May 16th here, May 17th, gold here, May 16th, US equity market bounce, May 16th. What we've been playing since May 16th is pullbacks against the higher time frame trend due to understanding the fundamental rate hike rumors were priced in, short-term dollar bears, the market moves in waves. We are manual retail traders who day trade or scalp, so we have to stay adaptive to these waves. Everybody understands that, right? But don't let this pullback here distract you from the higher time frame analysis. It's very normal for GBPUSD to have these pullback phases. That's all we've been playing here. It's not breaking higher time frame bear structure. It's not breaking the higher time frame fundamentals. I really want to drill this in everybody's head. Just because we can adapt to these short-term pullback phases, which is exactly what we're doing since May 16th, doesn't mean the overall bearish structure is broken here. Does that make sense for everybody? Same thing on gold here when we're looking at from April all the way down. Same thing with US stock market when we're looking at how this bearish market cycle has been running. Does that make sense to everybody? I want to make sure that that concept of us playing a pullback and corrective phase and the reasons why is understandable for everyone, but don't lose sight of the higher time frame bias. So I do still see a little bit more of upside across these pairs that we're looking at, but we can't get faded out of the higher time frame bias. So with that being said, on GBPUSD, pullbacks to 2.6, still looking for buys. Buys above 2.69, buys above 2.70. Still looking for buys to the upside to set up to better sell price points of interest on the higher time frame. Otherwise, my secondary bias in jumping back in sells would be below 1.254. If we can identify dollar buyers coming back in the scene, if we can identify the exhaustion on the upside from GBPUSD, if we can be breaking back below this price sensitivity area of interest at 254, that would be my secondary bias. Short term, still see some buys to the upside. Otherwise, if this short-term bias is incorrect, sells back below 254. Okay, so one more time. Obviously, if we have our buy analysis play out, right? We come to the sell zone and start to reject and take sells. We notice dollar buyers coming back into the scene. We notice stock markets turning bearish again. Obviously, this pathway of price, I'd be scaling sells back down as well. So this is the main bias here. Secondary bias is the higher time frame one if the pullback is short-lived. For example, we don't have to go exactly where I'm expecting. If we just come up to here and start to reject, I'd be selling back below 254. Okay? EURUSD, similar idea. What we have been playing on EURUSD is the market waves accordingly. Short-term pullback phase against a higher time frame bearish trend. I can still see us coming to dig higher into revisiting the sell side liquidity zone in previous lows on the daily time frame into 1.08, 1.085 area before seeing the sellers come back into play, continuing the higher time frame bearish trend, strengthen dollar on the higher time frame, and so forth. But in the short term, I still see us squeezing up to that area, which is around 1.08 here, 0.85. These gray boxes are just some medium-term price points of interest based on intraday price action and identifying key liquidity zones. But in the short term, we're still having dollar weakness. Buyers print these higher highs, pullback phase active. Pullbacks to 1.073 buys. Buys above 1.079. But around 1.085 to 0.87 would be looking for the higher time frame sellers to come back into play. Otherwise, If this is incorrect and we just start to notice the sellers come back into play and dollar strength come back in the table, safe sells back below 654. Keep in mind, I do have the expectations that the Euro economic data can give us a little bit of a short-term squeeze still to the upside, and we still are playing this pullback structure in the short term. It looks like we're still going to play this pullback structure to close off the month, start the new month, then into the new month, start running the higher time frame structure that I'm talking about. USDCAD. You can see the way USDCAD behaves. We have a lot of higher time frame revisits, even when buyers significantly print higher highs to this demand zone around 1.25. In the short term, we're still playing dollar softness, dollar bearish pullback until we identify the higher time frame buyers coming back into the scene. We also have crude oil hitting almost $120 a barrel today, if I'm not mistaken. Crude oil, it's at least sitting above $110 a barrel, which in terms of fundamental correlations brings a lot more strength to the Canadian dollar, obviously, as Canada's main revenue sources is oil exports. So smart money investors, the algos, translate any strength in crude oil as some short-term strength for the Canadian dollar. Now, we can see very strong bearish price action with the potential, if we trade below this zone, to easily come to 2.6, especially if we still have that continued dollar weakness. I'd be looking for sells from 2.7, sells below 2.64, potentially looking for a buy bounce from 2.6, higher time frame demand zone and liquidity zone. Obviously, if we break below 2.6, continue the sell run. The only thing you have to be cautious about that can give us a pullback tomorrow on USD CAD against this current bearish price action is the expectations of garbage Canadian data. So that short-term bad Canadian data, even that might give us the short-lived pullback to 2.7 before continuing back down. Okay. Last but not least, US30 stock market. GJ is going to be last. This is last for like dollar correlations and so forth, and in terms of the fundamental sentiment of the Fed's aggressive rate hike cycle and the impact it's had. For those of you who aren't aware, stock market has been in a bearish market cycle ever since the start of 2022, when the Feds have been signaling their aggressive rate hike cycle to come. If you go study 2008 bearish market cycle, if you go study the bearish market cycle of the year 2000, the Y2K, I think it was 2001, 2002, you will learn that during a bearish market in equities, due to market psychology of stock market buyers trying to save as much face as possible and that human greed, and also institutions liquidating positions from better price points with these short-lived dead cat bounces, you have a lot of frequent bounces from significant dips in lows being created. You can see that these bounces look like higher time frame buyers are coming back into the scene. Huge bullish candles or huge rejections, huge engulfing plays. But shortly after, as long as the higher time frame fundamental sentiment of the aggressive rate hike cycle doesn't get faded out, you can see you start to get your exhaustion confirms and buyers liquidate prices from better price points before continuing down in this overall bearish market cycle and trend. I can still see some short-term US30 upside to potentially 34K flat price sensitivity area before seeing buyers liquidate positions from better price points and sellers driving down even lower. Okay? I would need to see us trading above 34K, correcting this entire downside move to the left to validate a lot more buy-side liquidity in the market, and we'd need dollar to be continuing bearish and other asset classes that would be continuing bullish on inflation, such as, of course, gold continuing a bit more bullish as well. But otherwise, if as we come up to around 34K, if we notice dollar buyers in demand and dollar coming back into the scene, our other asset classes like gold turning a bit more bearish and the demand starting to liquidate out of that, as well as pairs like GBPUSD and EURUSD turning bearish, and we fail to break 34K, then we know this overall bearish market cycle is still very much intact. Let me show you guys an example. Right? Even when they're looking at the 2008, for example, in this bearish market cycle, this was more of the aggressive downside move that was more fundamentally induced. But the actual bearish market cycle started in this period here. It looks very similar to what we're looking at, does it not? Where every time you have these significant lows printed, you do get these aggressive dead cat bounces, they call it, within the equity markets. These dead cat bounces don't fade out or break that overall bearish market cycle and bearish market structure, and we continue to go down overall with each of these bounces, even though they're very large, being continuously faded out. If you were to look at the current structure and understanding the fundamentals of all-time high price points hit, right? All-time high price points at that time. I'll even label it for you guys. Fear developing based on GFC. The structure that forms after as well. Right? A bit of a double top at the all-time highs, which signals a lot more buyers exhaustion and sell side liquidity generated. Very significant dips created with very aggressive bounces from those dips as well, but gets faded out with the bearish market still being in control there. Right? Now, look. If you were to look at current market structure as well as the fundamentals, look, all-time high price points hit. Remember, these are record-breaking all-time highs. What led to this initial drop was FUD Russia tensions plus rate hike cycle coming, which a rate hike cycle is bearish for the stock market, right? A double top in this area, failing to break higher, and from there, bearish market structure with very aggressive dead cat bounces from these lows that are created. As long as we don't break back above 34K sell side liquidity zone, we don't break this structure, it's still in line with the 2000 bearish market cycle. It's still in line with the 2008 bearish market cycle, and it's still in line with the macro fundamentals and what we're currently seeing here. So on the short term, I still see a little bit more upside. Up to this sell side liquidity zone around 34K. Pullbacks to 33K buys. Buys above 33.5. Buys above 33.8. Higher time frame sells at 34K. Hopefully this is very informative to everybody. Hopefully it connects a lot of dots, opens some eyes for people. Obviously, if you want to learn these concepts in full detail, you have to watch the other educational webinars on the YouTube channel, and of course join the private channel if you want even more information. That's way more in depth. Secondary bias, if this is short-lived, is sells below 32,600. Okay? Now, when we're looking at GBPJPY, GBPJPY on the higher time frames is bullish. What we've had is buyers print significant higher highs. This rally was from a very dovish Bank of Japan with at the same time a more hawkish Bank of England. Rate hikes and rumors of rate hikes that came from the Bank of England, while at the same time the Bank of Japan was announcing an unlimited bond buying program, which is more bearish for the Japanese yen. we can see the same time GJ has had a pullback from the highs and new highs printed, Japanese yen was having a significant pullback from new lows being printed. But as we've been playing this pullback in short-term buys on the yen, aka that drop on GJ, we can't lose sight of the higher time frame analysis. I'm still expecting Japanese yen to either double top and collect more sell side orders and short orders to flood the market from 79, or start breaking below this previous high at 78.5 and turning more bearish. When we're looking at GJ, we have very strong buy side demand and liquidity zones that have been respected here from the 150s demand zone, and also we have broken and retested from previous highs, with this bearish market structure here being short-lived, creating more of a technical double bottom, which signals a lot more buy side entering the market, where if we can be trading above 165, 161.5 and 162, I see a lot of potential to be continuing the higher time frame trend, revisiting the highs printed by buyers, as that's all we've seen since the COVID crash on GJ. Does that make sense for everybody? When we're zooming into the daily, didn't mean to do that. When we're zooming into the daily time frame, we can see a lot more sellers exhaustion with failures to break this demand zone in previous highs, more buy orders being collected, where as long as we're trading above 160s, and also if we start to trade above 162, within this range, even give or take some pullbacks to generate more buy orders, I am expecting buyers back into the scene to at least revisit 163 and potentially be going to revisit these higher time frame highs. Japanese yen individually bearish, UK equities showing a bit more short-term strength, a more hawkish Bank of England, a more dovish Bank of Japan. On the intraday time frames, we're of course respecting more bullish market structure. I would like to clear above 161.8 to validate a lot more buy side liquidity in the market, but in the short term, even pullbacks to 160.5, 161, holding above current zone 161.5, safe buys above 161.8 is the safest buy options. I don't really see any fundamental or technical reason to be selling GJ. Brexit tensions, even though we have that noise in headlines, is nothing but noise. It's nothing but a distraction, as Brexit's been going on since 2015 and there's no new events brought to the table. It's all just well priced in and well known. We still have the hawkish Bank of England, more bulls than GBP. I would only be shifting out of this bias and selling below 160. So if my analysis is completely wrong, I can accept that. We can say, hey, I was wrong. I would sell and adapt to sells below 160. Whew! Okay, so I did a lot of fucking talking, everybody. We went through key fundamentals in focus, some key events to focus on, such as the end of the month, some holidays that are active during the week, the economic events we have in the second half of the week, some key fundamental points of interest, a volume and volatility reading, analysis of market sentiment and individual analysis of the yen, volatility index, and dollar. Then analysis fundamentally and technically across the board with trade ideas for gold, GJ, GBPUSD, EURUSD, USDCAD, and US30. This will always be available to rewatch as you wish, whenever you want to send this to anybody as well. These trade ideas are active for the next coming sessions and potential days that follow if we can extend this bias. I might be doing a New York scalping session on YouTube tomorrow morning or Thursday morning, and I'll also be coming on more frequently as a guest on Wicks Don't Lie and Raja stream. And this week, for those of you who enjoyed the top-down analysis webinar on gold and GJ, I will be doing another top-down analysis webinar on GBPUSD or Euro. Give me a quick spam in the chat. Do you guys want a top-down webinar this week on GBPUSD or EURUSD? I'll do a poll. next on GBPUSD or EURUSD? GJ is already done. If you go to this channel you're on right now, there's already a higher time frame top-down analysis done on gold and GJ that'll give you full fundamental and technical breakdowns. Okay? Now, for those of you who want to learn more about the fundamentals, more about trading psychology and the technicals that I use, and have the same type of confidence doing analysis as well as trading the markets as me, if you want more information, that's what's on the YouTube videos. Even though there's endless amount of value in the YouTube videos, make sure you check out the Capital Hungry private channel. Make sure you check out all of the resources and links within the description. I will see you all next time. Take care and have a nice day.